Hello, I'm Noel Lim on ASEAN Speaks by Maybank. US inflation came in lower than expected last week. Our analysts discussed the broader impact and trend, and if the US will slow rate hike. And as Malaysians go to the polls this Saturday, we look into the impact on markets in this tight race. Chua Hak, co-head of macro, moderates the call.
Hey, hi, morning. It's 14 November. Just a quick recap of last week's markets. I think there were three big market-moving news. First, the US inflation print came in lower than expected. Consumer price index increased 0.4% in October from the previous month and 7.7% from a year ago. Core increased just 0.3% for the month and 6.3% on an annual basis. That's also lower than expectations. Prices declined for medical services, used vehicles, and apparel. So markets soared on the low inflation print and treasury yields fell sharply. Hopes for a Fed pivot pushed the US dollar to its biggest two-day drop in 13 years. The S&P rose 6% last week and the Nasdaq rose more than 8%. The second major market event was the collapse of cryptocurrency group FTX, which has also filed for bankruptcy. FTX had secured a $32 billion valuation and had wooed a roster of blue-chip investors, including Paradigm, SoftBank, Sequoia Capital, and Temasek. In the bankruptcy filing, FTX indicates that it has more than 100,000 creditors and liabilities in the range of 10 to 50 billion. So that will be in line with the size of Enron. Bitcoin dropped 5% to a fresh two-year low of about 16,500 after the bankruptcy was announced. The third major market moving event was China's relaxation of quarantine requirements, even as COVID cases hit the highest since April. China cut the mandatory quarantine for overseas arrivals from 7 days to 5 days, while maintaining 3 further days of home isolation. China also ended tracing of second-degree close contacts of confirmed positive cases. And over the weekend, Bloomberg reported that China is planning sweeping measures to avert a property crisis. This includes 16 measures to address the liquidity crisis faced by developers to loosening down payment requirements for home buyers. Hong Kong markets rallied strongly last week on hopes of a China reopening, up 7%. And just an update on the US midterm elections, the Democrats appear to have kept control of the Senate, maintaining their razor-thin majority. But Republicans look set, however, to take control of the House with a slim majority, but the predicted rate wave never materialized. With the divided Congress, the next and last 2 years of Biden's presidency will probably be a governing gridlock. Some of the data to watch out this week includes US retail sales, which will provide clues on the health of the US consumer. US also releasing the PPI figures, which may impact the view on inflation. The UK will be releasing its CPI inflation, which may move to pound. Markets seem to be expecting a higher inflation print jumping to 10.7%. The UK new Prime Minister Rishi Sunak and Chancellor of Exchequer Jeremy Hunt will be announcing the budget on this Thursday, which could include a package of both tax increases and spending cuts. But an austere budget could worsen and prolong the recession, which the Bank of England projects to last until early 2024. Markets also waiting for some positive news from the Xi-Biden meeting in Bali. China's retail sales are also coming out, industrial production and investment data, but I think most economists are expecting another soft month as COVID restrictions cap activity. Japan will be releasing the third quarter data and a closely watched CPI inflation, which may swing the yen. The central banks of Indonesia and Philippines will be meeting this week and are expected to continue to tighten. We have Chua and Zamros to share their views on that. And some of the major companies reporting earnings this week includes Home Depot, Walmart, the Chinese tech companies Tencent, Alibaba, and JD.com. Today, we have Winson to comment on the big bond market moves, Andy on the sharp US dollar sell-off and whether this is an inflection point. Suhaimi on Malaysia's strong 3Q GDP surge, Chua on Indonesia's 3Q GDP and BI policy decision, Zamros on the Philippines GDP as well, and the BSP policy decision this week, and Anand on his latest ASEAN strategy, and lastly, Chee Ting on the plantation market. So let's start off with Winson. Some big news in rates, big moves in rates last week after the lower than expected US inflation print. What's your take whether this sharp drop in US bond yields is the inflection point? And what is the Fed funds future now pricing in for US rate hikes?
Hi, morning, Habin. Yeah, a very big move last week in rates. The 10-year US Treasury yield fell 35 bp, which is the largest decline in a single week since March 2022, when the Fed cut rate at an emergency meeting during the COVID crisis. I think prior to this better CPI prints for October, there were 2 months of upside surprises on inflation. The market was extremely bearish, likely with a lot of short positioning in Treasury, which I think was forced to unwind last week, and that probably exaggerated the fall in yields. So is this an inflection point for bonds? I think it's possible, although the market will continue to be volatile, up and down, could be 20, 30 bit weekly or sometimes overnight. The core CPI now has slowed to 0.3% month-on-month, annualized rate, as Habib mentioned, less than 4%. It is one inflation print in the right direction, although one data point is not sufficient to establish a trend at the moment. I think we should see smaller hike at the next FOMC meeting in December, maybe 50 bip, as what is currently priced in by the futures market compared to 75 bip previously. But having said the Fed will slow the pace of rate hike, it is still not sufficient for the Fed to stop hiking rate. So how high interest rate can go, as in the terminal rate, whether is it going to be 4.5, 5 or 5.5%, it is still very uncertain. The market currently is pricing for 4.9%. The Fed has made it clear that it will hike interest rate to a restrictive level to bring inflation down to 2%. But as we know, inflation has come down the last print, but it is still far from the 2% goal. Historically, the Fed tends to over-tighten. Near term, I think overshoot risk on yield is still possible, but 1 year down the road, I think it should be lower.
Winson, can you also update on the latest flows and moves in the ASEAN bonds, particularly in Malaysia?
It was net outflow from Malaysia and also some other ASEAN countries like Indonesia and Thailand. Malaysia released foreign flow data on a monthly basis, and the last update in October was a large 6 billion outflow. A year-to-date outflow about 8 billion. The foreign share of total outstanding has come down to 22% from 26% at the beginning of the year. Going forward, foreign flow pattern I think will continue to be choppy. The outflow risk I would say is moderate, but the domestic market should have sufficient liquidity and capacity to absorb the shocks, in my view.
Okay, thanks, Winson. Andy, so big move in the FX markets as well as the US dollar and dropping very sharply. So what's your take, whether this is just a temporary correction or an inflection point for the US dollar?
Hi, morning, Habin. Very important questions on the FX front. Indeed, we saw about 3.5 to 4% sort of slump in the Bloomberg Dollar Index late last week, and probably going to see around that sort of support so in terms of the dollar sort of softness. But our view is, I think, indeed, the weaker inflation or the data indicators showing a weaker inflation coming up over the next few weeks or months, indeed is one way to break out of the direction on the dollar front. But our view is, I think it seems too early to completely, I think, head for an exit. I think there's still a long road ahead to more acceptable inflation levels, and some of the surprises this month are not particularly durable. More structurally, I think the economy remains in some ways sufficiently resilient so that I think you need to actually bear in mind that there is still substantial uncertainty. I think the economy is already moving through that peak, sort of negative sort of impulse story. Outside of the US is another thing that you want to highlight. There's the recent news has all been negative for dollar. Surprisingly resilient hard data out of the euro area have pushed back severe recession fears. But I think the relaxing of COVID restrictions in China have also supported the risk sentiment. So all that may have helped to some extent. The other element is in terms of China's latest report of China's property rescue plan and all that. So our sense is, I think all those will help to support the dollar softness, but euro area outlook, I think, still remains troubling. The risk could be somewhat backloaded. I think there's still some element of more robust global activity, which could actually become self-fulfilling for Europe in some way. So in other words, what I'm trying to say is that I think it's still early days. There could be some retracement in terms of the dollar weakness sort of developments. So in general, we still think that the dollar would actually strengthen towards within the next 12 months, but we think it's a bit overshot also in terms of dollar weakness since last week. Harbin.
So Andy, any idea why the strong rally in the ringgit last week? I know that, I mean, all currencies went up against the dollar, but ringgit seems to have rallied a lot more.
Indeed. I think we've shared before that one big driver of Malaysian ringgit over the past year to date has been the renminbi move. You see renminbi, dollar CNH or 0CNY have actually come out quite strong relative to the dollar. Renminbi had come out strong, especially after the announcements last week of the China cut quarantine period for inbound travelers to 8 days. And I think also the latest report of China's property rescue plan. So China sort of variable or factor continues to play a significant role on the ringgit. So in fact, when our estimates showed in terms of correlation, ringgit is the highest in terms of correlation with renminbi now compared to the past. So that could have played a significant role on top of the dollar sort of softness. So the dollar have actually fallen by about 3.5%, together with the China, both on the COVID announcements and also probably on the latest report, the property rescue plan could have helped a bit, especially with the renminbi strengthening quite significantly. So I think those are the few of the factors that sort of distinguish why ringgit probably moved, and the fact that I think also ringgit have actually moved quite undervalued significantly. So I think a significant pullback on the ringgit front is quite significant.
Okay, thanks, Andy. Suhaimi, Malaysia's GDP for the third quarter surged dramatically. So how real is it? I guess whether it's a base effect or whether it's something which exceeded your expectations, and what's driving the recovery, and whether is it sustainable?
Good morning. Malaysia's third quarter 2022 GDP surged 14.2% year-on-year from 8.9% year-on-year in second quarter this year. So close to our estimate of 14.8%, whereas consensus was around 12%. Clearly, the economy benefited from full economic opening this year, even more so for last quarter, because the economy shrank 4.5% year-on-year in third quarter last year due to another round of lockdown caused by the outbreak of the Delta variant of COVID-19 virus. Last quarter's growth was broad-based. All economic sectors expanded, with faster growth in services, manufacturing and construction, as well as rebounds in agriculture and mining. Similarly, all demand aggregates rose, led by consumer spending growth and pickup in government spending and investment activities, plus rebound in net export of goods and services. Economic growth will slow in fourth quarter this year and next year, given current global economic downturn spearheaded by major economies and the dampening effect of this high inflation, high interest rate environment. But there are some mitigations, we think, to the downside risk to Malaysia's growth outlook. These include the ongoing drawdown of household excess savings, plus tourism recovery that can serve as buffers to consumer spending growth. Investment growth momentum is also there, supported by robust approved FDI that is currently translating into rising actual FDI, as well as ongoing and new infrastructure projects from basic rural and transport infrastructure to digital and green infrastructure, plus our assumption of Bank Negara raising OPR from the accommodative level of 1.75% to a neutral level of 3% by January next year, rather than going into restrictive level of higher OPR. So overall, with 9-month 2022 growth of 9.3%, we revised upwards 2022 full year real GDP growth forecast to 8% from 6% previously.
So I mean, the media reports I'm reading seems to be pointing a very uncertain result for the general elections. So not as straightforward. So will the outcome of the general elections impact the economy and recovery?
Now we have to acknowledge the near-term wildcard to economic outlook is outcome of the 15th general election this Saturday, and implications on political stability and policy clarity. These include what will happen to budget 2023 that have to be retabled when the parliament reconvene after the election. There will be questions also on implementation of development and infrastructure projects, as well as what will happen on fiscal policy sides in terms of tax measures and subsidy reforms, for example. And given the current narrative and expectations by the real experts, the full-time political analysts, indicating no clear winners in this election, I think for now, we just maintain our forecast of 2023 economic growth slowing to 4%. So basically half of what it was or what it is going to be or expected for 2022.
Great, thanks, Suhaimi. Chua, Indonesia also reported stronger than expected third quarter growth. What's driving the recovery, and is it sustainable?
Morning, Hak, morning everyone. So 3Q GDP growth for Indonesia at 5.7% came in above our and consensus expectations. And this was driven by firm investment as well as robust exports. Gross fixed capital formation rose by 5% compared to 3% in the second quarter, with a surge in investment in machine and equipment as well as vehicles. And this is in line with the jump in FDI numbers that we saw, a strong 66% acceleration in the third quarter, driven by downstream projects including nickel and copper. Household consumption continued to rise, but eased slightly from the second quarter at 5.4%. This was despite last year's low base, which was caused by the Delta wave, and likely reflects the impact of the fuel price hike in early September, which weighed on consumer confidence and retail sales. Government consumption continued to decline for the third straight quarter as the government continued to cut back on COVID-related spending, while net exports of goods and services stayed robust because of continued strength in goods exports, as well as the tourism rebound. Based on the early indicators for October, it seems that growth is being sustained. Private consumption has been more resilient than expected despite the fuel price hike. Consumer confidence index has inched up to 120 from 117 in September. And retail sales also remain relatively stable, rising by 4.5% compared to 4.6% in September. But overall, we are expecting momentum to ease in 2023. Looking at GDP growth at 5.1% next year compared to 5.3% this year because of the significant slowdown expected in external demand, the impact of BI's policy tightening, as well as the higher fuel costs.
So Bank Indonesia is meeting this week. What are you expecting? And when do you see the policy rates peaking?
For this meeting, we expect BI to hike by a smaller 25 bips. To support domestic demand after two straight meetings of 50 bips hikes in the past 2 months. Core inflation at 3.3% in October is picking up more slowly than expected, despite the big increase in fuel price. And we are penciling in one more rate hike in December of 25 bips and a final hike of 25 bips in the first quarter of next year. And that would bring the terminal rate in this cycle to 5.5%. That's slightly higher than the end 2019 level of 5%.
Great, thanks, Chua. Zamros, so it looks like Philippines GDP also surprisingly stronger than expected in third quarter. What's driving this recovery? And do you see it being sustained as well, going to next year?
Hi, morning, Habin. Morning, everyone. Yeah, Philippines GDP expanded higher than expected at 7.6% year on year. That makes for the first 9 months of this year, the economy grew by 7.7% year on year. But I think most importantly, the quarter on quarter growth seasonally adjusted, the economy expanded by 2.9%. as compared to a decline of negative 0.1% in the second quarter. We think that there are four major factors that contributed to the higher growth than expected so far. Firstly, being the economic reopening, there's less movement of restrictions. We look at the global Google Mobility Index already improved to 32.3 versus 26.1 in the second quarter. Secondly, on the face-to-face school sessions that started in August, implemented in stages, will be fully implemented by this month in November. That's definitely boost domestic demand and economic activities and creating jobs as well, which contributed to the third factor, which is the robust labor market. The unemployment already down to 5% in September as compared to 7.8% average last year. And the final point is on the with the general election and presidential election already done in the second quarter, and the movement, the transition from the previous administration to the new administration has been smooth. So that eliminates a lot of uncertainty in the economy. With that, we raise our growth forecast for this year to 7.3% from 6.5% previously. Next year, we're looking at slower growth at 5.5%, mainly because of the impact from the global economic slowdown, higher policy rate, and also from the higher inflation in the Philippines as well.
So the Philippine Central Bank will meet this week as well. What are you expecting? I guess, will the governor back off from the 75 basis point rate guidance hike that he gave, I guess, following the collapse in the dollar last week?
Yeah, we were looking at a 75 basis point rate hike by BSP on Thursday, mainly because of inflation is still high in Philippines at 7.7%. There's headline inflation in October, and the core inflation at 5.9%. And we think that the economy is able, I mean, with the growth 7.6% in the third quarter, the economy is able to absorb further rate hike. We also estimated that the output gap in the Philippines already positive in the third quarter. And third point is on the, I mean, the need for to keep the peso's performance in check by BSP. We are still looking at the policy rate to peak at 5.5%. It's either going to be end of this year or early next year. Habin.
Thanks, Zamros. Anand, you released your ASEAN strategy report, the key themes and highlights.
Yeah, hi, morning, guys. So we had a pretty good fortnight for ASEAN markets. Despite the 75 basis points increase in US rates the week before, ASEAN markets were holding their own. I think one key exception is the Vietnamese market, which fell 9% again over the last 2 weeks. So you can see from Figure 2 here that Vietnam is now the worst performing market in all of Asia. It's down almost 40% year to date. And that has a lot to do with domestic factors, the regulatory crackdown and the fraud allegations against certain companies. But broader ASEAN has been resilient. And two reasons, I think. One, third quarter reporting season so far has been fairly benign. Most earnings have been coming in within expectations, and the sectors which we expect to do well, like the big cap consumer and bank sectors, have delivered either in line or they have outperformed expectations. I think the other point is the markets are looking quite attractive at this point, and you can see that in Figure 1 in terms of, especially when you juxtapose it against what the previous speakers have been talking about. We're seeing earnings or GDP upgrades, to be precise, across ASEAN. Singapore, Malaysia, Philippines, Indonesia, 3Q numbers have been very robust, and 2022 GDP numbers have been raised. So I think that's giving investors a lot of confidence in earnings delivery this year as well.
So Anand, what are the key changes to your top buys and top sells?
Yeah, I think we have done very few changes in the last 4 weeks as results season has come through. As I mentioned, reporting has been largely in line. Where we've seen some downgrades is in the tech sector, like this week, we've done hashtag SP to hold as we get a bit more cautious on valuations given the emerging down cycle in the industry. And we've been upgrading a lot more defensive stocks. I think Netlink in Singapore is one example this week. Also Central REIT in Malaysia. What they have in common is stable cash flows and dividend yields of above 6%. So at this point, very attractive for investors looking at defensive options. But overall, Hak Bin, I think the sectors we like continue to be banks across the region, especially the Singapore banks, DBS, OCBC, UOB, and also the Indonesian banks like Bank Mandiri. And consumer. So if you look at our top buyer ideas on the cover page, you'll see some pretty sizable consumer exposures there to play the GDP recovery across the region, like Indofood in Indonesia, you've got CP Oil in Thailand, and you've got SM Investments in the Philippines. So banks, consumer, very much in focus. Some taking the money off the table for tech.
So Anna, I guess with the elections coming out this weekend, I just have to sneak in a question, because there are some investors asking us, how would you position in terms of the Malaysian market?
Yeah, we don't have the usual sort of speculation about election plays anymore, because given that the last couple of years has really been a dog's breakfast for Malaysian politics, there are no corporate alignments that are very obvious anymore with certain parties or certain political personalities. I think we fall back on our quants investigations into the how to be positioned into elections, and we had a report on this from the quants team about 3 months ago. The three sectors that stand out: banks, consumer staples, and healthcare as being the outperformers into elections. So I think we would prefer to be positioned in those sectors going into next Saturday.
Great, thanks, Anand. Chee Ting, CPO prices have corrected quite sharply from their peaks, but have rebounded slightly. What are the latest updates from stockpiles and the demand supply dynamics? And I guess where do you see prices going on from here?
Morning, Hak Bin. So the MPOB's October stockpile hit a 37-month high at 2.4 million tons, 4% higher compared to a month ago. The stockpile accumulation was boosted mainly by strong palm oil output in the month of October, which hit this year's monthly production high at 1.81 million tons. And this more than offset the higher growth in exports as well as domestic consumption. Now, it remains to be seen if MPOB stockpile has peaked for the year, although prelim export estimates for the first 10 days, November, showed strong positive trend. So the MPOB stockpile will trend for the rest of the year will largely depend on the production output in November and also December. Malaysia's monthly output traditionally peaks in either September or October of every year. So this year may not be an exception, as Malaysia Palm Oil Board's monthly output may have peaked in October. Production is likely to trend downwards from November, but the pace of decline may only gain momentum from December and all the way till February of next year. And recently, the Malaysia's Met Department issued forecasts of heavy monsoon rainfall expected to hit the east coast of Peninsular Malaysia, the east coast of Sabah, and parts of Sarawak between now and January. And rainfall for these areas could be as high as 800 millimeter in a particular month. And this raises the risk of possible flooding in low-lying areas across over the next 3 months. Heavy rainfall and flood may disrupt field operations, crop evacuation, or even result in crop losses, lowering crop potential basically. Some of these areas are key producing regions. And across the globe, La Nina in its third consecutive year may also impact South America's ongoing planting and eventual harvest of soybean, which will come on board sometime from March, April onwards next year. The market is presently anticipating a large soybean harvest from South America on the assumption of a normalized weather. So if weather fails to be friendly, then the crop will fail and supply will be diminished. So as for CPO price outlook, heavy rainfall and flood may have always been price friendly in the past. So even after the recent CPO price rebound, CPO price still trades at more than $400 per ton discount to US soy oil, Argentina soy oil, Germany rapeseed oil, and these are above historical averages. Hence, supported by the declining production trend till February of next year, I believe CPO price will be sustained at current levels of around 4,000 ringgit per ton into early 2023.
Chee Ting, remind us of your top picks in the plantation space.
Sure, our preferred buys in the region are Kuala Lumpur Tepong, First Resources, and Bumi Tama.
Great, thanks. That's all we have for today. Have a good week ahead.
Get more information from your trading rep and the Maybank Trade app. I'm Noelle Lim on ASEAN Speaks by Maybank.